David, I'm interested to learn, what is your outlook for stocks in 2013? Even with the recent pullback that we've seen, the S&P 500 is still up about 10% for the year-to-date period. We've got Obama in office and a slew of other issues to think about here and overseas in Europe and China. How does all this play into where you think stocks go next year?
You know, we think stocks do go higher in 2013. Between now and 2013 could be a rocky period as the fiscal cliff is negotiated, but we do think 2013 could be good for the market, really for three reasons. One is central banks around the world remain very accommodative. Number two, and very importantly, the U.S. economy is actually doing better than expected. The numbers that are coming out are better than expected, primarily driven by a better U.S. consumer. And you're seeing that in housing, you're seeing that in better employment, you're seeing that in consumer confidence hitting a 5-year high. So the U.S. consumer is doing better, the U.S. economy is doing better than expected. Same thing with China. The data from China that's coming out for the past 2 months now has been better than expected, showing pretty good growth, and in fact, China might have bottomed out in terms of their growth rate in the third quarter of 2012. So that's very important that world economies are starting to improve. The third reason is valuation. So the market today does sell at about 2.1 times book value. Back in the crisis in 2008, it bottomed at 1.7 times book value, and in 1991 it bottomed at 1.8 times book value. So we're pretty close to those lower levels, and certainly as we do move through these problems, that valuation could rise.
So you mentioned the fiscal cliff is an issue that we have to get past here in the next couple weeks, actually. One of the issues that a lot of investors are kind of focused on is the potential increase in taxes on dividends. How are you addressing that issue? I know you're in charge of the dividend value fund at Nuveen, so what do you think is going to happen there?
Yeah, on the dividend front, certainly taxes are going up. We do know that. So the question is just how much. We would view a win if taxes went up to 20% for dividends and capital gains, and that has been proposed by Senate Democrats. And of course, you do have the Affordable Act surcharge of 3.8% on top of that. We would view that as a positive outcome. The negative outcome is if we do fall off the cliff and tax rates go back to ordinary income tax rates on dividends then would be over 40%, and that would certainly be a negative for the market overall and for the dividend paying stocks.
How likely is that worst case scenario?
You know, from our point of view, we think that worst case scenario is very small, less than 20% probability.
Okay, what are some of your top picks in the dividend value fund?
There's two areas that we like in particular. One is large pharmaceuticals, and if you think about large pharmaceuticals, they're kind of not that affected by what's going on right here. You know, so the dividend yields are very good, and two names in particular we like, and they're similar in certain respects, and that's Pfizer and Merck. Both have good drug product pipelines coming up. Both are restructuring or selling off non-core assets to refocus on their drug business. Both yield well over 4% and going higher,
pretty nice.
Which is nice, and both generate a ton of free cash flow. An area that's a little bit directly tied into what is going on, and that is the large financial diversified companies. So the Citigroups and the Bank of Americas, we do like those, and we have added to those recently.